Okay, welcome back, everyone. I'm going to cover a couple of questions here that have been forwarded to me. Are we going? Excuse me, got the wrong thing. Richard says, John, I need to clarify. I have a copy of the Ohio Department of Taxation letter for an Ohio amended return, not an unemployment issue, that they will accept either an IRS acceptance letter, the IRS refund check, or an account transcript. Okay, now the Ohio Department of Taxation has stated specifically in their announcement they wanted an IRS tax transcript. But if anything else is willing to be accepted, then go for it. These things change without announcement, but that is what they officially put out originally. Lynn says, I had several farmers who received grants from U.S. Department of Agriculture, and these payments are showing up as income on the returns. Is that accurate? To my understanding, it is, Lynn, unless the grant or any of the loans are specifically legislated out of existence as to taxability by Congress, they are taxable. And I will assume both Barry and David, who with me, have heard nothing to the contrary. Although I don't see why these grants should be taxable as they stand, they are now. If you've heard something to the contrary, gentlemen, please share that with me. All right, we're going to move on.
John, I have one more question while
Sure.
we're doing this. This came to me by email and it has to do with an Amish families that are receiving the advanced child tax credit payments that they wish not to receive.
Well, the only way they can get out of it, and I actually got an answer from IRS on this, which is something of a miracle. Of course, it's not authoritative, is that they have to opt out. They have to go through the opting out procedures. They've got to opt out, period. And I will repeat again, they may not want the money. They may not take the money, but they will receive this letter, this 6419 letter, showing they received the payments. There is no mechanism from anything the IRS has published to reduce the amount of payments by checks returned or amounts paid back. In fact, some of our participants can tell you about the difficulty they're having with stimulus payments that they tried to return. So this, unfortunately, the Amish are caught in this. And here again, maybe we need some legislation that is more representative of our population. This could be one of them. Sorry. Okay. Regarding the forgiveness of economic injury, disaster loan grants and everything, I want to remind our friends in a seminar here, be sure to make a Schedule M1 adjustment for income recorded on books this year, not included on tax return, for the amount forgiven in the year. In the year it's actually forgiven. Thus, if it's forgiven in 2021, the entry will be made on the Schedule M for 2021. The Schedule M M1 entry lines are Form 1120, line 7, Form 1120S, line 5, Form 1065, line 5. Note also, my friends, that the amount of any forgiveness is treated as tax-exempt income and increases the basis of the S corporation shareholder or partner in a partnership. Make sure their basis worksheet shows that the amount that you've entered, which is treated as tax-exempt income on the Schedule M, has flowed through and has increased their basis accordingly. So, additional practitioner procedures alert for 2022 filing season. Determine if the client received the proper amount of the third stimulus payment, if any. Require the client to furnish the stimulus letter they received and reconcile the amount received to the 2021 return. Make sure your interview and tax package is properly in depth to ascertain the number of minor dependents. And I might add, who can claim them. Obtain the letter 6419 to reconcile the advanced child tax credit payment or proof through the client's portal involving the child tax credit, how much payments they receive. And I should say this, but when I shouldn't put in there conduct a proper in-depth. We do conduct proper in-depth tax package, ask questions. What I should say is expand your in-depth and tax package to ascertain the existence of casual income sources in order to prepare the client to the realities of reporting this income due to the new Form 1099-K requirements. Again, start now. Obtain the Forms 1099-K. Be prepared to do that for 2022. Caution the client in the interview against the earning of casual income and not telling you about it, not reporting it. Place additional emphasis, as we've talked about throughout this seminar today, on preparing the correct Form 8867, which you do. But you have to put additional emphasis on making sure you're protected with information and assurances from your client, written assurances, due to the enhanced tax credits. And we will discuss later the taxpayer's determination of fraud with the various credits. Enhance your interview and tax package determine the amount, if any, of the IRA or other distributions that were taken in 2020 and deferred for future tax years. I can guarantee you, particularly if you picked up a new client in this area, the IRS will be following this through. Determine the amount of the various PPP loans and other federal grants that were forgiven, as well as the receipt of state and local grants. These grants are all over the place. Make the necessary entries to the Schedule M of the partnership, S corporation, C corporation returns. And here again, adjust the basis computation of partners and S corporate shareholders, only the ones that get a basis adjustment for this, for forgiven loans and grants that are not income for federal purposes, and these amounts are treated as, quote, tax exempt income. So can we have polling question number 19? We can get all these polling questions out of the way. When a paycheck protection loan, economic disaster loan, or other SBA grant is forgiven, answer number 1, an entry should be made on Schedule M for the forgiven amount. Answer number 2, the partners or S corporation shareholders basis is increased by the forgiven amount. Answer number 3, only 1 and 2. Answer number 4, none of the above. And if you think about this adjustment, Schedule M adjustment for tax exempt income, which increases the partner shareholders, S corporation shareholders basis, is like a double benefit. Not only is this income not taxed, it increases their basis. They get a double benefit from that, a free increase in basis where they're not contributing to capital. I will remind you that any of these forgiven amounts for federal purposes still are treated for financial purposes only, as extinguishment of indebtedness. Okay, so the polling questions ended. Share results. It's answer number 3, only 1 and 2. Now we're going to look at proposed legislation. Now, why should we study this? Nothing's been finalized. We should study this because there is a lot here that is a warning shot across the bow if it's passed. If it isn't passed, it's warning us. Because one of the truisms, I can use that word, about tax legislation that many will agree with, which I have seen in my many years of practice, is that once legislation is introduced, even if it isn't passed, it's right there in the forefront of the congressional mind for future sessions. So effectively, if any given section passes now in the short-term future, the client must be prepared, and we need to consider planning now, even if certain legislation in here, which appears to be very draconian, is not passed. Begin this, the American Families Plans Act. It will increase the top marginal income tax rate from 37% to 39.6% for taxpayers with taxable incomes of over 509,300 for individuals filing jointly and 452,700 for taxpayers filing singly. Now, adding the state and local tax rates, and you could easily have a marginal income tax rate in excess of 45%. Increase the tax on capital gains and dividends from the current maximum of 20% to a maximum of 39.6% of taxpayers with an adjusted gross income of $1 million or more. Now, regardless of what happens with this provision, you can be guaranteed there'll be some tinkering with the capital gains rate. Remember, there is a free zone where if all the income up to, and I believe it's $70,000 is capital gains, it's not taxed, no tax at all. You can believe that the best tax is a hidden tax. So we have some mechanical adjustments, very possible. Be on the lookout for that. Now, this is one that has a good possibility of passing. In addition to the capital gain rate of 39.6%, the net investment income tax passed with Affordable Care Act legislation of 3.8% would apply for an effective federal rate of 43.4%. This net investment income tax is being looked upon by Congress as a surtax to be applied universally. And when we're adjusting, adding the state and some local tax rates with this net investment income tax, the total effective rate could easily exceed 50%. Now, any proposed change is likely to be accompanied by a proposal to raise all the underlying graduated rates, eliminates, as I said, the free zone where a taxpayer effectively pays no tax up to a certain amount of capital gain or dividend income. And here is an interesting provision hidden in all this that you can guarantee will see the light of day, even if it doesn't pass this time, future legislation. Expand the application of the net investment tax of 3.8%, the surtax, to shareholders and partners of pass-through entities where they earn more than $400,000 from the entity. They want to apply the NIT tax of 3.8% to their flow-through income or their total income from these flow-through entities. And it looks as if they want to, for example, if an individual earns $500,000 from their proportionate share of S corporation or partnership income, the 3.8% would apply on 100,000. And there's some talk of it applying on the whole amount. The other part of this, which is more revealing, is a provision would coordinate this NIT tax with the self-employment tax. So an individual would pay the SECA tax. If they would pay the SECA tax, they would pay only the NIT tax. Now, what this means is what they're proposing effectively is the implementation of self-employment taxes on the net income of an S corporation, which they have been studying for 15 years. This diminishes further planning and using an S corporation as a tax vehicle because Congress has been debating this. And now they're looking on this, the net income of an S corporation. It's not only current consideration, but future ones. Particularly, it's mentioned again and again, professional journals, when we're talking about, quote, bailing out the Social Security system. This is a quick fix. So we need to think about that. At the minimum, The net is being proposed on the net income of an S corporation at a certain level. This is dramatic. And remember, once legislation is enacted, it is very easy to change and expand that legislation. In this case, lower the amount subject to SECA or NIT for S corporation shareholders. We're seeing that happen. Congress is now focused on the issue of subjecting the net income of S corporations to self-employment tax. Again, this is proposed legislation. Again, this is warnings. This may not happen now, but it could happen, and probably, in my opinion, will happen in the future. Now, this is a principal reason, and in my teaching and my study of entities, choice of entities for tax purposes, what I've seen others say is the principal reason for being an S corporation, because S corporations have many negative confining restrictions. So consider this possibility in the future when making the election. They want to make permanent the expansion of the Premium Assistance Tax Credit Acts and the American Rescue Plan Act. We mentioned that. They want to make permanent the expansion of the Earned Income Tax Credit in the American Rescue Plan Act. We mentioned that. They want to make permanent the expansion of the Child and Dependent Tax Credit provisions in the American Rescue Plan Act. We have mentioned that somewhere. And they want to make permanent the expansion of the child tax credit provisions in the American Rescue Plan Act, if further expanded by making it fully refundable in all cases. Limiting, this is something that's been talked about. This could easily happen. Limiting the deferral of gain from like-kind exchanges to $500,000 per taxpayer, with a total limitation of gain to $1 million for taxpayers filing marriage joint. This can be a real problem if this provision is passed. Making permanent the excess business loss limitation, which is to expire in 2026 for non-corporate taxpayers, another limiting factor. Eliminate the current provision to allow a stepped up basis on the increased value of assets over the decedent's basis in an estate. Assets are inherited are subject to gift tax. Now, coupled with this above, a distribution of assets will result in a taxation of all gains over $1 million. So what you have is a twofold attack involving estates. You involve a situation that would no longer allow a stepped up basis for assets that are inherited. On top of that, there would be a taxation of all gains of assets over $1 million. Each beneficiary would be allowed a $1 million exclusion, with all gains above that amount to be taxed at the capital gains rate. And the $1 million exclusion would be indexed for inflation after 2022. Now, it is not that hard to hit the $1 million exclusion. And frankly, the attractiveness of this provision to certain members of Congress is the people that would be vastly hurt by this, and they will be hurt, are minority of people of the voting public. And the majority of the public thinks that anyone that receives more than $1 million, well, they're rich. They should be taxed on it. Now, there's been discussions. Congress has said, well, don't worry about this, because we're going to allow an exception for small businesses and farms as existed in prior estate tax law. These exceptions, by the way, were far from perfect and often generated unintended tax consequences. So I don't see these exceptions as having much value. And one of these exceptions has been described as not requiring the tax to be paid until the family-owned business, including farms, are sold or otherwise cease to be family-owned. So what they're saying is, okay, we won't tax you on the gain if you inherit a farm, but we will tax you on that gain when you stop using it as a farm and you may sell off the land. So in other words, the tax is going to follow the inherited property as proposed. Other provisions would include the taxation of illiquid assets over the tax would be paid over a 15-year period. This is also going to be a problem. This provision proposed recognition of gain when assets are transferred to or out of a trust, partnership, or other non-corporate entity. So there's going to be a provision there to go after the gain when assets are transferred in and out of one of these entities, aside from the taxation on the appreciated value of assets that are distributed to shareholders or partners. Recognition of gain when assets are transferred out of a revocable grant or trust to the extent the transfer is to someone other than the deemed owner of the revocable trust. The spouse of the owner trust are to liquidate a debt of the deemed owner. A revocable grant or trust is very common. So we're going to say these trusts, which are really altered egos, which are used as disregarded entities by the IRS, well, they really exist for these purposes. If you have transferred them there to avoid probate purposes under this proposed legislation, you transfer them out to a third party, you're going to hit with taxes. So we can see that this. Now, some Democratic members in Congress have suggested that instead of the provisions we've just discussed, they would favor a provision that would eliminate the stepped up basis without taxation of any gains and have the deceded spaces carried over to their beneficiaries. This could easily happen. This provision, unfortunately, has a lot of supporters in it. And all of these proposed provisions, coupled with the reversion to prior estate tax, remember, beginning January 1st, 2026, the current spousal exclusion per spouse, which is about, I think, 11.7 million this year, will expire, will revert back to a flat 5 million. You could see how all of this would further aggravate the severe tax consequences of having a taxable estate. Regardless of what changes are finally legislated, there is going to be a strong possibility that we will have to file, regardlessly what we are required to do, tax returns, federal estate tax returns again. So, and I'm going to say this to you again. In past seminars, we had discussed the importance of keeping strong proof of basis for qualified valuations. IRS looks at this. Now, a possible effect of the introduction of this legislation is a reintroduction of the original IRS proposed regulations that were greatly restricted and effectively eliminated valuation discounts that lowered the estate gift tax implications. Now, the average American taxpayer has no idea what we're talking about. But valuation discounts of up to 10, 10, and 10, 30%. Prior administration, the IRS had introduced these very complex draconian regulations, which effectively eliminated valuation discounts. They were vetoed by the administration, and the IRS was forced to withdraw. Don't think for 1 minute the IRS doesn't see their chance to reintroduce those regulations. So whether or not this legislation passed, the warning shot has been made. Any type of tax estate planning we do now or gift planning will be grandfathered. So it's very important that we review with our clients particular situations which would expose them to tax issues involving estates for either their estate's trusts to make gifts, to do planning, as well as to avoid the obvious probate issues. So polling question number 20 and the final one today. Everyone give a collective hooray. In counseling our clients about the possibility of proposed legislation becoming tax law in the future, we should answer number one, emphasize, excuse me, gift, trust, and estate planning. Two, answer number two, capital gain avoidance strategies. Answer number three, discuss like-kind exchanges of real property. And answer number four, all the above. All the above. Now, we don't know what's going to happen. Here at Ohio State, we'll be the first to let you know when and if the legislation's passed. There's a major tussle going on right now over the budget being proposed. Tax proposals included in the infrastructure bill were stripped out of that bill, but they've been reintroduced as part of the budget one. So, okay, I think we're done now. And the results are, the answer is number four, all of the above. We have a lot of counseling to do with our clients here. The legislation proposes to increase funding for the Internal Revenue Service by $80 billion over a 10-year period. The funding would target $30 billion for technology implementation and upgrades. The $30 billion for implementation of technology upgrades is vastly over needed. It is needed. The IRS is still using software programs from the 60s, Cobalt and Fortran. In the late 90s, the Defense Department was asked if they would go in and remodel, redo the IRS technology system, upgrade it. And I said, absolutely not. So this is really needed, and it will cost every bit of $30 billion. Now, the real problem with this is the funding would provide the IRS with the ability to hire additional enforcement personnel in the audit and collection functions. The intended purpose is to expand the audits of wealthy individuals. Here is what I think, bull manure. The IRS should use any additional funding for personnel to fix their service centers, to upgrade the number of employees, the quality of employees, so we don't have these massive screw ups which occur with regular attention by the IRS, the regularity of these, that checks are processed timely, refunds are made before we have audit personnel. Now, the IRS got themselves into this position over the decades, the 80s, 90s, into the 2000 decade. They had strategic analysts which said we don't need to hire. They refused to ignore the fact that their population of workers was aging. A third of them can retire after 2021. Talking to IRS enforcement people and management, yes, they're hurting very bad. But here's the problem with this expansion of audits to wealthy individuals. It isn't going to happen. The IRS is as number-driven today, statistic-driven, as they have been in their entire existence, despite congressional things. They're going to go after the low-hanging fruit, which is our clients, the small business people. It takes years for an examiner to develop the expertise to, quote, audit wealthy individuals, because wealthy individuals have multiple entities, and all those entities are required by the IRS manual to be audited. So it takes time. You don't get much statistics out of auditing wealthy individuals. IRS likes to turn over the audits, likes to have as many as they can. So again, this is the low-hanging fruit. And I have real concerns about this. Now, the $80 billion proposed for them was stripped out of the infrastructure bill, but it's reappeared in the budget bill that is being considered. And I'm going to say, as I said before, the service centers and the taxpayer assistance divisions need to be staffed or restaffed. They're both highly dysfunctional, and they need to be more customer oriented as the IRS was supposed to be doing for many, many years. Now, this is an interesting provision. And it's caused financial service industry to raise a storm protest. A major expansion of information returns would be provided by the IRS, to the IRS, I mean, would receive the provision of this information from financial institutions that must and will show a comprehensive list of all deposits, withdrawals, checks written. In other words, this is what the IRS examiner does anyway. It's a basis of their bank deposits method. Now, there is a great lobby against this, and I can see why. The financial institutions have said this will discourage people from using bank accounts and so forth. Yes, it will. But the IRS asked Congress for this, and they will try and get their wish list in terms of that. It would pertain to all business and individuals, and it would include all bank, loan, and investment accounts above a $600 threshold. Aside from the massive burden on financial institutions, as I said, and I do believe this is correct, it will cause fewer people to use financial accounts. Now, there is in this enhancing accuracy of tax information by allowing the IRS to require e-filing of information returns and expanding the quality of returns. This was coming. So there is legislation in there by allowing the IRS to say you have to file all of your information returns electronically. Expand broker information reporting crypto assets. This is happening. This is currently a major dispute that's going on in Congress because the IRS wants a vast expansion of reporting on the crypto assets. And you have a client that has crypto transactions of any sort, they have a big bullseye on their back. They are radioactive. Extending the statute of limitations on listed transactions. There is no shame here in trying to expand the power of the IRS. Listed transactions. For example, captive insurance companies were listed transactions. They would expand the statute, almost doubled in size. Expanding the liability provisions of unpaid corporate income tax by imposing the requirement that such taxes be paid by the shareholders. What this would be is a significant legislative change that says the shareholders are responsible. No longer the determination by the collection division of IRS who is really responsible for unpaid taxes. Flat law that says the shareholders are responsible for the repayment and payment of unpaid corporate taxes. Increasing the oversight of return preparers by providing the IRS with the explicit authority to regulate paid preparers of federal tax returns, including, and I should say, the imposition or reimposition of minimum competency standards. Now, we will discuss this later and the introduction of separate legislation regarding this issue. So those of you a few years ago that went through the program to get the RTP certification, you're sitting just fine because this is what they want. You would not have to do, according to the legislation, go through that program again. American Job Plan, raising the corporate tax rate to 28% from 21%. Extensive revision of tax law affecting global transactions, including the disallowing of deductions attributable to exempt income, limiting inversions, etc., imposing a 15% minimum tax on the earnings of large corporations, allowing a 10% tax credit, creating one, as an incentive for locating jobs and business activities in the United States, disallowing tax deduction for expenses incurred in conjunction with moving jobs overseas. Now, the housing and infrastructure provisions involving the tax law would expand the low-income housing credit, would establish a new neighborhood homes investment tax credit, would be making permanent the new markets tax credit, would provide federally subsidized state and local bonds for infrastructure. It would, and this one is significant, certain members of Congress have for 30 years not liked the idea of intangible drilling costs in the oil and gas industry. For example, traditionally 75% of the cost of drilling a well, which is expensive, can be written off in the year of drilling as tangible drilling costs. So if the well costed, for example, 200,000 to drill, which is very cheap, 150,000 could be written off in that year. Congress wants to eliminate that deduction. People in the oil and gas industry said there's very little drilling going on now, but if they eliminate this, you can expect a spike in oil prices to $100 plus per barrel. Elimination of a variety of other favor fossil fuel tax provisions. Expansion of various alternative energy and renewable tax incentives. Establishment of a tax credit for electrical transmission incentives. Providing a partial credit for electricity generated from existing nuclear power facilities. Have you realized how nuclear power, which was the scourge of America in the 70s and 80s, is suddenly making clean energy, alternative energy comeback? We can see it here by the provision to provide a partial credit for electricity generated from existing nuclear power facilities. Establishment of various tax credits for qualifying advanced energy manufacturing. Establishing various tax credits for heavy and medium-sized zero-emission vehicles. Establishment of various tax incentives for sustainable aviation fuel. Establishing a tax credit for low-carbon hydrogen. Establishing a new and extending various energy efficiency and electrification incentives, which would affect the average taxpayer. Establishing a disaster mitigation tax credit. Enhancement and expansion of the carbon oxide sequestration credit. Expanding and extending the electric vehicle charging station credit. Reinstating the expired Superfund excise taxes. Modify and redefine the oil spill trust fund financing. In summary, these two proposed bills are just that. They are proposed, and what they will look like in their final form is anyone's guesses. But provisions in these tax bills are being incorporated in the proposed budget plan, which we will see within the next 2 weeks being up for a vote and possible passage by Congress. One of the most alarming provisions, if you're a student of tax law, is in the introduction of proposed legislation, the initial appearance appeared that these provisions were retroactive to April 28th of 2021. So whenever they're passed, they're retroactive. Now this retroactive change is by those who propose this to say, well, we didn't mean it that way. We meant it only to pertain to capital gains tax rate provisions. So anyone that sells capital gains today, if there are any changes made to the capital gains rate, will have it retroactive if this part of the legislation and intent goes through to April 28th of this year. Any corporate tax rate increases for fiscal entities would be prorated to increase the portion after January 1st, 2022. However, the administration came forth after a lot of criticism and said our proposed budget indicates the effective date will be on or after January 1st, 2022 for all other provisions. Still, ladies and gentlemen, sit in your chairs and watch this closely. Still, we need to see what really will happen. Now, this is something that is also a warning shot. This has been published. An advisor to President Biden, former Representative John Delaney, has suggested that another revenue raising method would be the elimination of bonus depreciation. Note that bonus depreciation starts to phase out beginning January 1st, 2023 under current law, and is completely eliminated on January 1st, 2028. So could bonus depreciation be allowed to expire altogether? Yes. Bonus depreciation is an accounting gimmick. It is a great investment for the economy in that individuals can write off the cost of personal property, equipment, etc., defined. This is done in European tax systems, which are high tax systems. But we initiated in this country, it has worked. Now they're talking about possibly eliminating it. I'd keep your eye on this one, because this is very possible. The Taxpayer Protection and Prepare Proficiency Act. This bill was introduced in a bipartisan manner to formalize the discussion in the American Families Plan to regulate tax preparers. Now, such sentiments have growing bipartisan support and the support of a number, and I say here numerous, but a number of external stakeholder groups. It would give the IRS the power to regulate preparers in accordance with the court decision that stated the IRS needs congressional authority. When the IRS began this regulation of tax preparers and was struck down by the court struck it down saying that Congress didn't give you specific authority. You get specific authority and you can regulate preparers. Now, the legislation is focused on preparers who are currently unregulated. The provisions of the bill is authorize the IRS to reinstate their 2011 registered tax return program. So some of you, a number of you that became a registered under the program should now realize that the registration process, the registration you went through was not wasted. It never was. It would give the IRS full authority to regulate preparers. It would grant the IRS the authority to revoke an incompetent or fraudulent preparer's tax identification number. Now, I think we can all agree with that. Clarify that certain non-signing preparers who are individuals employed by and prepare returns under the supervision of an attorney, CPA, or enrolled agent are not required to obtain a PTIN. Require a U.S. government accountability office study on the sharing of information between the IRS and state authorities regarding PTINs issued to paid return preparers and to put preparer minimum standards. So we don't know if that legislation is going to be passed. There is a lot of bipartisan support for that type of legislation. I think we can see that coming. The Tax Deadline and Simplification Act. This is another act. House Bill 4214. Now, this bipartisan bill was co-sponsored and introduced in the House of Representatives. And the intent of the legislation is to simplify the quarterly estimated tax installments. The legislation would change the due dates for individuals for the second and third quarters so that all payments are due after the end of a quarter. And a lot of this legislation is based on the period of time, the second, third quarters, when individuals are actually filing their return and need more because of their past filing experience and accurate forecast of what their estimated taxes are. The bill would establish one threshold of $400,000 for the determination of whether a taxpayer obtains a deduction. And this is the Small Business Tax Fairness Act, again, This bill would establish this one threshold and would allow the taxpayer to face this particular deduction in a case. It would phase out for the deduction for individuals who have income in excess of 400,000. This pertains specifically to the qualified business income deduction. And the phase out would result in the complete elimination of the deduction at $500,000. So there is an attack on the qualified business income deduction. The eliminated deduction would be in effect for 4 years. It would also establish, if they could do this, this would be remarkable, a single definition of what is qualified business income, which will apply to all taxpayers. And the effect of this particular provision would be to expand the deduction to middle income service businesses. So that's what we have. Tax extenders, pardon me, I need a drink. Tax extenders we should be aware of. Meals from restaurants for amounts paid after 12/31. So there, David and Lo, I had it right. And by the way, I've changed the slides and the polling question to reflect the notice. That's already been done. And I'll give the new slides to Julie for her to turn into for everyone to access. Flexible savings accounts, health or dependent flexible savings accounts are allowed to carry over unspent amounts from 2020 or 2021 to the next year. Mortgage insurance premiums through 2021 are deductible as qualified residence interest. Credit for health insurance costs for qualified individuals. This credit is in place through 2021. Non-business energy property credit in place for through 2021. Alternative fuel refueling property credit in place through 2021. Two-wheel plug-in electric vehicle credit in place through 2021. Classification of certain racehorses as 3-year property for depreciation purposes is in place through 2021. Now extended through 12/31/2023. Residential energy efficient property credit, such as solar credits at 22% and 26%. Energy credits under Section 48. Extended through 12/31/2025. The new markets tax credit. Employer credit for paid family medical leave. Exclusion from income of qualified employer payments of student loans. And if you haven't realized by now, which I'm sure you have, that many of these items are contained in the current budget tax bill and may be permanent. All right, so we have conflicting situations where we have extensions already passed by Congress, but there are permanent extensions, permanent provisions in proposed legislation that exists. The work opportunity credit, exclusion for gross income of discharge of qualified principal residence indebtedness, but a new lower amount of $750,000. So all of these are through 12/31/25. Note this lower amount of the discharge of qualified principal residence of $750,000. Now they permanently extended these provisions. The medical expense deduction threshold of 75%, now permanent, not 10%, which was the number that if it was not going to be permanent, that it was going to. It's now 7.5%. Repeal of the deduction for qualified tuition and related expenses, resulting instead in an increased income limitation in computing the lifetime learning credit. Exclusion from income of qualified tax benefits for volunteer firefighters and emergency medical response. That was nice of them. There you go. Exclusion for the meager benefits given to these individuals for their service. I'm being sarcastic here in case any of you don't realize it. Now, my thoughts regarding the provisions extended through 2021 probably will be another extension. our incorporation in legislation. This budget goes through with some of this tax legislation. We'll have a whole new tax bill that we will be studying at our fall webinar or our fall schools. Okay. So with that, that's a proposed legislation. Let me look at some questions here. Need to amend a return for a missed 1099-R, but client also has refund due because unemployment exclusion. My inclination is to wait until they get the automatic unemployment refund. John, I would do that simply because everything will get screwed up in the computer if you don't. The 1099-G from the state of Ohio Workers Bureau compensation is taxable, correct? Yes, it is, Joyce, fully taxable. Do you have a credit number, a good number? And this person is laugh out loud for IRS where practitioners can call to check on delays of refunds for 2020. I'm glad you mentioned that, anonymous attendee, because people that have been getting through to the practitioner lines, when they have been told there's nothing we can do about it. And so Ted is telling me I'm doing a good job, and I appreciate that, Ted. We always try. Denise, how many of the preparers with PTINs are bad versus how many of the bad preparers are ghost preparers marking returns as self-prepared? Denise, this is a good question. These ghost preparers labeling tax returns as self-prepared. I have picked up a couple of clients that had decent sized businesses that had a ghost prepare, self-prepare. They were marked for audit because they were self-prepared. The IRS will tell you this. Self-prepared returns have a greater chance of audit because they're more likely mistakes are going to be made. Okay. All right. Let's see here. Okay. All right. So those are the questions we have. Let's look at the enhanced enforcement. Ladies and gentlemen, I am not in favor of enhanced enforcement right now until the IRS gets their act together, the service centers. We need to get the basics done. Do they need more collection personnel to go after money owed by the government? They always have. Do they need more examiners? Unless you're prepared and I'm prepared to educate these examiners, and that's who will be educating. I'm not pontificating. These are the practical experiences, but let's look at some of the areas that are hot compliance targets right now by the IRS. Offshore banking, that has made a resurrection, kind of faded a little bit. Now the IRS has come back very strong, Treasury, to look at foreign bank accounts. Self-employment tax avoidance and issues. We've talked about the 1099-Ks. We've talked about the gig economy. We have IRS sending out letters saying, you didn't report self-employment tax. It appears that you need to report it, particularly with those that have filed a Form 4029 claiming exemption. Cryptocurrencies. This should be the number one item. Cryptocurrencies are at the top of the IRS hit list. But I mentioned there are 14 transactions involving cryptocurrency. Some of these are quite complicated. So we'll see at the level of sophistication of the IRS examination of these. Conservation easement syndications. Conservation easements never get into when they're involving a syndicate. These promoters, stay away from those. Those are a regeneration of the abusive tax shelters of the 70s, 80s, and 90s. IRS is doing increased audits of tax-exempt entities. Virtual currencies. If you're participating in this, you're a target of IRS enforcement. And the commissioner has asked Congress, looks like he's going to get it, authority to collect information on cryptocurrency transfers at over $10,000 by anyone who receives cryptocurrency in over 10,000. The IRS is also going after the cryptocurrency brokers right now, and they're doing this through Congress, so this should be interesting. The current discussions would expand the reporting requirements. And if you have a client who's engaged in virtual currency, have them sign a representation letter. Believe me, for your protection that they have disclosed all information to you. Earned income, child tax, and American Opportunity Credits. We've seen the expansion. The IRS has stated, I earlier said it was 18 billion, I apologize. They have said they made 16 billion in incorrect earned income credit refunds in 2020, 4.5 billion in incorrect child credit refunds, and you can believe that is going to soar with the new advanced child tax credit and enhanced child tax credit, 7.2 billion in 2019, and 2.3 billion in incorrect American Opportunity Credit refunds. So you're looking at a figure which equals 22.8 billion in omitted incorrect refunds, fraudulent refunds in these credits, which here, if we're going to look at enforcement, this is where the IRS should be focusing. And a lot of these can be done from the service center. So exasperated by these, we're going to see with these new credits having an increase in these prime audit targets, and these will be correspondence audits. Now, the IRS currently audits about 300,000 returns claiming earned income tax credit. 40% of the errors pertain to whether an individual is a qualifying child. Again, due to the changes made to the earned income credit, you can expect more audits to the capacity the IRS has it. I don't see there is necessary a problem with doing these earned income credit audits through the service centers. The Form 1099-K, the IRS is currently using data generated by the Form 1099-K under the current rules, not the new beneficial rules to the IRS that were passed this year to allow them to go to the 600 threshold. And as I said earlier, these 1099-Ks, the IRS is totally enamored with them and the use of them in the audit program. Self-employment taxes, the IRS is currently continuing to match tax returns with self-employment income to a lack of self-employment tax, which I mentioned earlier. The majority of these matchings result in a letter sent to the taxpayer inquiring as to the lack of self-employment tax, seeking the payment of it. Responses are taking, in some cases, several months to get cleared. And the inquiries also include individuals that are exempt from Social Security and have filed Form 4029, particularly our Amish clients. Now, I want you to note, as a practitioner, that always obtain from any taxpayer who claims exemption, they're filed and approved. It has to not only be filed, but approved Form 4029 and keep it in their permanent file, because more and more these forms are being asked for. There has been a rise in instances where employees of sole proprietorships and partnerships had their claim to be exempt from Social Security suddenly challenged, including those that are in a situation where they are being paid as wages and claim to be exempt. Very careful with these, get proof of these, both as a client, as practitioner. Now remember, corporations and S corporations are required to withhold Social Security and match it, even on legitimately exempt individuals from Social Security. This is in accordance with a Supreme Court decision in the Miller case in the early 90s. The IRS's Large Business and International Division has a continued audit. I like how they use this word campaign, like a military campaign, identifying and auditing limited partners and members in LLC professional service firms claiming exemption from self-employment tax. This was a result of some greedy attorneys in Indianapolis who lost a 2017 court case where they tried to have just the majority of their partnership income be declared limited partners, not subject to self-employment tax. So the status of a limited partner has an ability, depending on the income, to increase the audit profile. Large partnerships, the IRS claims they're using a specialized group of agents and specialists in partnerships issues to expand their audit of large partnerships. These returns are, according to the IRS, being selected by their use of data analytics. Now, the IRS is increasingly using analytical knowledge to their selection. Now, how they use it and the quality of what they're getting is probably up to debate, but they are increasingly using it, and they're using outside firms, contractors, to provide this information to them. The IRS has updated for small retail businesses their audit guide, which is available at irs.gov, involving these type of businesses as to what the examiner should really be concerned about. Now, this audit guide is now directing the examiners to the new gig type businesses. And they mentioned food trucks, which are exploding as an item that is going to be tackled in an audit of small businesses. The two major issues that the audit guide is alerting the examiner to is the determination of whether unreported income exists and whether the cost of goods sold are correct. Other potential issues are discussed. Ladies and gentlemen, the IRS will use the bank deposits method in determining unreported income. That is, at all the deposits from all the bank accounts, get a total for each, sum them, compare that to the return and go, hey, which of these deposits were transfers? Which of these were loans? If you can't explain it, it's income. So in some cases, I have two clients that I go ahead and do the bank deposits method on for the IRS to make sure that I'm picking up all the income. This is where you will have a probe involving small businesses using the bank deposits method. Now, the IRS has received a large number of amended returns for pre-2018 years, claiming the now eliminated domestic production deduction, resulting in refunds wanting several $billion. I don't know how these people sleep at night, but these are obviously the people that have enforcement problems. And these amended returns claiming these deduction are a focus of current audits. Passports and delinquent taxes, the IRS has finally got their act together regarding the provision placed in law in the 2017 Tax Cut Jobs Act, requiring that when a taxpayer owes $54,000 or more in delinquent taxes, that they can be denied a passport or have their current one revoked. They are accomplishing this by notifying the State Department of who these individuals are and advising them by letter that their name was submitted to the State Department regarding the enforcement of this provision. Now, this provision does not apply to individuals who have installment agreements, live in a federally declared disaster area, or in bankruptcy, or were determined by the IRS that the debt cannot be collected due to hardship. Now, this last one is, I don't know how you would get, and you certainly wouldn't get a writ determination from the IRS, because these are the ones that are turning over to the collection agencies, that the debt cannot be collected due to hardship. So audits and valuation methods. In prior audits, we discussed the absolute need to obtain a contemporaneous, professional, and desirably certified valuation of property that is inherited, part of a basket purchase, for example, property that is inherited. The IRS is now using county auditor assessor valuations to challenge the lack of these formal valuations, where individuals have claimed a stepped up base. So we're automatically going to disallow your stepped up base and will be very favorable and really generous to you to give you the county auditor's assessment, which you can use if you want to use that. But these valuations are designed for property tax reasons, particularly in these times, lack any formal connection to the underlying economics. High income delinquent filers. As we discussed last year, a shocking report was issued that stated that the IRS was not pursuing high income taxpayers who were not filing the returns. The IRS is currently pursuing those individuals. It's about time of that. But they're not pursuing them very good, very well. They're having collection officers ask for these returns. They're not capable of examining what's on the return. Just give us a return. Right, wrong, or indifferent. Delinquent filers, tax preparers continue. So as the pandemic restrictions are lifted, these individuals will have on-site visits from revenue officers. Again, I don't think much of this program, unless there's a follow-up to look at these delinquent returns to see how accurate these are, because individuals are just turning over information. Non-compliance. Now, this is something we should be well aware of. The Office of Treasury Inspector General for Tax Administration, TIGTA, has cited the IRS for failure to vigorously enforce backup holding rules. In their report, they're saying because the IRS isn't enforcing these backup withholding rules, this is costing billions in lost revenue. Here is the problem with this. Wherever TIGTA has given a blistering criticism of IRS has responded and has sometimes overcompensated with an enforcement program. So you can expect some, not many, inquiries about backup withholding here. The TIGTA said to IRS when there was 440,000 Form 1099 filings with a missing or incorrect identification number, they found that the failed backup withholding on just these forms was 13.3 billion in lost revenue. So most of this was the 1099s with non-employee compensation. You can see vigorous enforcement by IRS coming in place as they get the staffing to do this. So watch your backup withholding requirements. Make sure that you're getting the W-9s. Make sure that you're getting correct Social Security number, employer identification numbers. Now, the IRS is stepping up audits of traditional IRA and Roth IRA accounts that hold non-traditional assets, such as real estate. For example, rules in holding real estate in an IRA are very strict and easy to run a file, causing a prohibited transaction, causing a revocation of the account and the entire amount brought in. And the IRS increased audit focus on these is due to the large number of taxpayers ignoring these. Real estate owned by the plan, where the owner does repairs, that's a prohibited transaction. Plan owner renting to or from the plan, prohibited transaction. Selling property to or purchasing it from the plan, it is a prohibited transaction. Co-signing or guaranteeing a loan that involves the plan, prohibited transaction. And the list goes on and on. Particularly one was a popular one a few years ago by so-called planners, purchasing a business in an IRA in which a plan owner has a personal interest. You cannot do that and draw any compensation from a business and what the IRA is invested, lending money to or borrowing from the plan by the IRA owner, paying any type of promotion fee of an IRA, using related parties to engage in any of the prior 8 examples. There are many more examples of self-dealing. So that being the case, I'm going to answer some questions as we finish up here, Barry. So do you mark your own return self-prepared, but put your firm name on it? It doesn't matter. Your own return is self-prepared. I do it both ways. It doesn't matter. To fix those credit frauds, they should make the taxpayers use a paid registered professional, prepare their taxes, and hold the preparer accountable. This is submitted by Gerald. Or wait, they already hold us accountable. I would fix 90% of the fraud situations. Look, they are going after self-prepared returns for the earned income credit these other credits because there is a higher incidence of being incorrect. In Ohio, you can't get food stamps, unemployment without showing all kinds of documentation, but another person has answered, but tax return can be filed and a huge refund of thousands of dollars without showing any documentation. And when we be careful with this showing of documentation suggestion, because the IRS and Congress will go nuts on that. They already want us to do the audits. Beth says, I responded to a CP 2000 notice for tax year 2018 and have reviewed several IRS letters to allow an additional 60 days review. In the meantime, the client is getting notices requiring payments or else. Beth, this is the one hand doesn't know what the other one is doing. And you have to respond to these CP 503 notices with copies that, dear IRS, we've been responded to the CP 2000 notice, the basis of this. What is wrong? Please stop harassing the client with these notices until you make a determination on my original response. Would it help to send Form 9423 collection appeal request collection letters until a review is completed? Beth asked that. The answer is no. Curtis says, I did not have any PPP forgiveness in 2020, but I have roughly 5 so far in 2021. Where do I report the forgiveness of the PPP2 loans? Also, can I still deduct the expenses with the PPP2 loans? First of all, you can deduct the expenses. Secondly, you're going to make that forgiven income, that Schedule M1 adjustment that I mentioned, and an increase in basis for individuals that are partners or shareholders. And I believe, unless there are other questions, Barry, that's it. So you want to get here. I want to emphasize to you, you have my email, you have my phone number. Please do not hesitate. You're part of our Ohio State family group. All of you have been to our seminars or webinars. We're here for you at OSU. I'm here for you. I do believe that one of the things that made me become a CPA and have the practice I have is helping my fellow practitioners. We're all fellow travelers. We're all in the same boat. We need often to sound off our ideas. I will call a practitioner friend of mine and say, this is a stupid question, and I should know this answer, and I think I do, but throw it at him sometimes when I'm tired. So please stay in touch with me. Thank you very much for your attendance at this webinar. We appreciate it. We'll see you at our seminars or in our webinar in the fall.
We hope so. Thank you, John. Excellent set of materials, and got you answered about roughly 100 questions on top of all of the slides that you presented. A lot of thank yous coming in, and we do appreciate it as always, John. Just want to remind everyone the registration is open. As John mentioned, we hope to see you this fall at one of our 2-day schools or the 4-day webinar, which is the online option for you this year. And also some of our other webinar offerings, the ag tax issues, the ethics webinar, and all of those things you can register for now. We also want to remind you that the slides will be available. The updated slides will be available, and Julie will have those posted by tomorrow. And we will also have recordings available of this webinar for those that have participated today, along with just one more reminder about our evaluation. We want your feedback, so you could access that through the chat feature, and we will also have a follow-up email coming out to you. So once again, thank you for joining us for our summer income tax webinar on behalf of all of our folks here that have been helping in the background, and of certainly John, who's
I want to thank Barry, sorry to interrupt you, Barry and Julie, for all the tremendous work both of them do to put this webinar together and to make this update and the other webinars possible. Barry, thank you. Julie, thank you.
Thanks again, John. And this will conclude the formal part of our webinar for today. And we look forward to seeing you this fall. Have a safe and happy summer.
Thank you.